I was staring at my Bloomberg terminal this afternoon, and something felt wrong. Silver was up 4.21%. Gold was barely moving. The spread was tighter than I have seen it in weeks. And yet everywhere I looked, the headlines were screaming about silver's collapse, about the bull market being over, about weak demand destroying the precious metals thesis. Here's what they're not telling you. Right now, as I'm recording this, there's a $7 billion sell order being executed in the shadows. It's not coming from panicked retail investors. It's not coming from some hedge fund that lost faith in precious metals. It's coming from index funds that are legally required to dump their silver holdings by January 15th, whether they want to or not. Let me back up for a second. I'm a private commodities analyst. I've been stacking physical silver for 12 years, and I have spent most of that time watching the paper markets create illusions that have nothing to do with reality. I built this channel because I got tired of waiting half a day for mainstream media to report what I could see happening in real time on my data feeds. And frankly, I got tired of watching all these AI avatar channels pump out garbage speculation with no real data behind it. So here's the deal. I use this AI avatar for one reason: speed. I can get this information to you now, not tomorrow morning, when CNBC finally catches up. The voice is artificial, but the analysis is mine. The data is real, and the stakes are higher than most people realize. We are officially in day 2 of a 5-day rebalancing window. The Bloomberg Commodity Index is slashing silvers, weighting from 9.6% down to 3.94%. That's not a typo. They're cutting it by more than half. And every single fund that tracks this index, every passive vehicle that's legally bound to mirror its composition, has to sell. They have to sell regardless of price, regardless of fundamentals, regardless of what's actually happening in the physical market. This is what I call a phantom event. The retail world sees the price action and assumes something fundamental has changed. They read the headlines about weak demand and start questioning their thesis. Meanwhile, the real story is playing out in the liquidity structure of the paper market, and almost nobody is talking about it. But here's where it gets interesting. Despite this $7 billion wave of forced selling, silver is outperforming gold by a factor of 5 today. Think about that. Billions of dollars in sell orders are hitting the market, and the price is still climbing. That tells me something very specific is happening beneath the surface. The physical buyers are absorbing the blow. Now I'm going to walk you through the exact mechanics of what's happening, show you the math behind this liquidity vacuum, and then I'm going to tell you exactly what I'm watching for in my own portfolio over the next 120 hours. This is not advice. I'm not your financial advisor, but I am someone who has seen this pattern before, and I know what it looks like when paper markets diverge from physical reality. By the end of this, you're going to understand why the current price is a lie, why January 15th is the line in the sand, and how to spot the signal that tells you when the forced selling has finally stopped. But first, you need to understand something critical. If you try to catch this falling knife too early, you will get cut. There's a specific sequence of events that has to play out, and timing matters more than conviction right now. So let's pull this apart. The primary claim I'm making is this. We are watching a massive passive selling directive create an artificial price floor that expires at market close on January 15th. This is not a fundamental decline. This is not a loss of faith in precious metals. This is a mechanical process driven by index rebalancing rules that most retail investors don't even know exist. Here's what I'm going to show you. I'm going to explain the mechanics of what I call a passive flow shock. I'm going to run the actual math on the weighting collapse. And then I'm going to walk you through my personal battle plan for the next 5 days. Because this is the kind of opportunity that only appears when pricing inefficiencies create temporary dislocations between paper and physical markets. The promise is simple. By the time we're done, you will understand why the paper price is currently divorced from reality, and you'll know exactly what signal to watch for. That tells you the bouncing ball has hit the floor. But you have to be patient. You have to let this play out. Because if you jump in too early, you're going to be swimming against $7 billion in forced selling. And that's a fight you cannot win. Let me give you the current snapshot. This is data I was looking at just a few hours ago, around 1:45 Eastern Time. Silver was trading at 79.88, up 4.21% on the day. Gold was at 45.0923, up only 0.76%. The bid-ask spread on silver was sitting at 14 cents, which is tight. Abnormally tight for this kind of volatility. That spread tells me we're in a high-frequency battle zone right now. Algos are fighting over every tick. And here's the thing that should make your ears perk up. The price is currently fighting a war at the $80 psychological level. That's not an accident. That's a line in the sand. Above 80, retail sentiment shifts. Below 80, fear starts to creep in. Now, while the Bloomberg Commodity Index is dumping paper silver, the actual spot price is up over 4%. Let me say that again. Billions in sell orders, and silver is still climbing. That divergence is everything. What that tells me is that physical accumulation is absorbing this $7 billion blow in real time. Somebody with very deep pockets is on the other side of this trade. And they're not selling, they're buying. Stop for a second. Look at what I just said. Even with billions in forced selling hitting the market, silver is outperforming gold by a factor of 5 today. The invisible hand that usually controls these markets is losing its grip. The paper sellers are desperate to complete their mandate, but the physical buyers are hungry, and the deadline is approaching fast. Here's what I need you to understand about index rebalancing. Because this is the core mechanism driving everything we're seeing right now. A passive flow shock happens when a major index changes its portfolio composition. When the Bloomberg Commodity Index decides to reweight its holdings, every fund that tracks that index has to adjust. They don't have a choice. It's written into their prospectus. They are legally required to mirror the index, regardless of market conditions, regardless of price, regardless of their own views on the asset. Let me give you an analogy that makes this crystal clear. Imagine a law gets passed that says grocery stores have to stop selling apples by Thursday. They have 5 days to clear every crate off the shelves. It doesn't matter if the apples are ripe. It doesn't matter if demand is strong. The shelf space is being reassigned, and they have to dump their inventory at whatever price they can get. Now, what do you think happens to the price of apples during those 5 days? It crashes. Not because the apples are rotten, not because people suddenly stopped wanting apples, but because there's a wall of forced selling hitting a market that knows the sellers are desperate. And here's where it gets even more interesting. The market makers, the guys who normally provide liquidity and smooth out price movements, they pull their buy orders, they let the price fall. Why? Because they know exactly when the selling has to stop. They know the deadline. So they wait, they let the forced sellers capitulate at lower and lower prices, and then they scoop up the inventory at the bottom. This is what I call a liquidity vacuum. It's a temporary hole in the market structure that gets created when passive flows overwhelm natural price discovery, and right now we are sitting inside that vacuum. The Bloomberg Commodity Index has issued a firm directive. Silver's weighting has to drop from 9.6% to 3.94% by January 15th. That's not a suggestion, that's a rule. And every dollar of that adjustment has to be executed before the market closes on the 15th. Once that last dollar is sold, the vacuum gets filled. The forced selling stops. The market makers come back and price discovery returns to normal. But until then, we're in the storm. Now let's talk about the actual math, because this is where you start to see how big this really is. The conservative scenario, based on the data I'm working with, shows the Bloomberg Commodity Index slashing silver's weight from 9.6% to 3.94%. That's a reduction of roughly 5.66 percentage points. When you apply that to the total assets tracking this index, you're looking at approximately $7 billion in forced selling. $7 billion. That's not a retail panic. That's not a hedge fund unwinding a position. That's a tidal wave of rigid, non-discretionary selling hitting a limited time window. And here's the kicker. This is all happening while gold's weighting in the index remains relatively stable. Gold is not getting cannibalized. Silver is. What does that do to the gold to silver ratio? It artificially inflates it. Right now, the ratio is being pushed higher. Not because of fundamentals, not because gold is suddenly more valuable relative to silver, but because of this mechanical selling pressure. Let me walk you through the checkpoint recap so we're all on the same page. We know that $7 billion has to move by the 15th. We know that this selling is non-fundamental. It has nothing to do with demand, nothing to do with supply, nothing to do with the actual value of silver as a monetary metal or industrial commodity. And we can see that the physical market is already fighting back. Despite billions in sell orders, the spot price is climbing. The numbers don't match the narrative. When the rigid selling stops, when that deadline passes, and the passive funds have completed their rebalancing, the rubber band is going to snap back. I know what the skeptics are saying. I've seen the arguments on Twitter, on Reddit, in the comments sections of every precious metals video that's come out in the last 48 hours. They're saying the crash is already priced in. They're arguing that because silver is up 4% today, the $7 billion sell-off was already front-run by smart money, and there's nothing left to gain by waiting for the rebalancing to complete. Let me tell you why that argument is wrong. Passive funds cannot front-run their own rules. They are mandated to sell between January 9th and 15th. They don't get to choose when. They don't get to be strategic about timing. The rules are explicit. They have to execute within that window, and they have to execute the full amount. What that means is the largest blocks of selling are happening right now. Not last week, not next month. Right now. The price action we're seeing today is not the resolution of the selling pressure. It's the collision between forced sellers and physical buyers. It's the market trying to find equilibrium, while billions of dollars in non-discretionary orders are still flowing through the system. This is not a market crash. This is a cleansing process. It's the removal of passive long positions that were never based on conviction in the first place. They were there because an index said they had to be there. Now the index is saying they have to leave. Don't confuse a temporary liquidity exit for a permanent trend reversal. The fundamentals that drove silver higher have not changed. Industrial demand has not collapsed. Monetary debasement has not stopped. What's changed is the index weighting, and that change is mechanical, not fundamental. So what happens next? What should you be watching? I'm going to give you the dashboard indicators I'm tracking in real time, the signals that will tell us when the forced selling is done and when the market is ready to snap back. First, open interest. If silver's price falls and open interest drops at the same time, that tells me the weak hands are out. That tells me the passive funds are closing their positions and the liquidation is progressing. When open interest stabilizes or starts to climb while price is still under pressure, that's your first signal that the selling is nearly complete. Second, the TS window. That stands for trade at settlement. This is the period before the U.S. market close when passive funds typically execute their end-of-day rebalancing trades. Watch the volume and price action during this window every day between now and the 15th. If you see heavy volume and downward pressure during TS, the forced selling is still active. When that pressure disappears, you'll know the rebalancing is done. Third, and this is the big one, January 15th is the moment of lowest sentiment. That's the day when the forced selling has to be complete. That's the deadline. After the market closes on the 15th, there is no more mandate. The passive funds have finished their rebalancing. The liquidity vacuum gets filled. But here's what you need to watch for. Don't just mark the calendar and assume everything changes at 4 p.m. Eastern on the 15th. Watch the gold to silver ratio. If it hits an extreme statistical deviation, if it gets pushed to levels that are historically unsustainable, the mean reversion is going to be violent. I've seen this before. I watched it happen in the oil markets during the last major commodity index rebalancing. The price got hammered during the forced selling window, hit an absurd low, and then snapped back 30% in 3 days once the selling stopped. The same thing can happen here, but you have to be patient. You have to let the process complete. On January 16th, the invisible hand disappears. The forced sellers are gone. And what's left is the natural supply and demand dynamic between physical buyers and whatever paper shorts want to keep fighting. Now let me tell you what I'm watching in my own portfolio. This is not advice. I am not telling you what to do. I'm telling you what I'm doing. And you can make your own decisions based on your own risk tolerance and your own analysis. I have 3 triggers I'm watching. Trigger A. If silver dips toward the $75 support level before the 15th, and if spot premiums on physical silver remain high, I'm looking to increase my physical exposure. Why? Because high spot premiums tell me the physical market is tight. It tells me dealers are having trouble sourcing metal, which means the paper price is disconnected from physical reality. That's the opportunity. Trigger B, if the $80 level breaks with high volume, I'm sitting on my hands. I'm not chasing it down. I'm waiting for the bouncing ball signal on January 16th. Why? Because if 80 breaks before the forced selling is done, we could see a flush down to 75 or even 70. I don't want to catch a falling knife. I want to wait until the selling pressure evaporates and then position for the snapback. Trigger C. I'm watching the gold to silver ratio like a hawk. If it begins to decline from a peak after the 15th, I'm favoring silver's recovery elasticity over gold. Why? Because silver moves faster. When the ratio mean reverts, silver outperforms. That's just math. I am waiting for the tide to recede. I want to see what gets left on the beach, and I'm not making any moves until I see the signals I just outlined. Are you ready for what's left on the beach? Let me bring this all together. We have $7 billion being forcibly sold by January 15th due to Bloomberg Commodity Index rebalancing. This is creating a temporary liquidity vacuum that is pushing the paper price of silver down, even though the physical market is absorbing the selling and the spot price is climbing. This is what I call a golden pit opportunity. It's a pricing inefficiency caused by mechanical flows that have nothing to do with the fundamental value of silver. The paper price is a lie. The fundamental value is the truth. Here's your actionable takeaway. Watch the January 15th close. That is the line in the sand. That is the moment when the forced selling has to be complete. After that, we're in a new game. Now, I want to go deeper on something I mentioned earlier because I think this is where a lot of people are going to get tripped up. The difference between paper silver and physical silver is not just academic. It's not just some theoretical concept that precious metals bugs like to talk about. It's a real measurable phenomenon that shows up in pricing, in availability, and in the behavior of different market participants. When I say the paper market is dumping silver, I'm talking about futures contracts, ETFs, and index funds that hold claims on silver, but don't actually take delivery of the metal. These are financial instruments that track the price of silver, but they're not the same thing as owning physical bars or coins. The Bloomberg Commodity Index rebalancing is happening entirely in the paper market. These funds are selling futures contracts and ETF shares. They're not selling physical metal because they never owned physical metal in the first place. But here's what's fascinating. While this paper selling is happening, the physical market is showing signs of extreme tightness. Premiums on silver eagles, on silver bars, on any kind of deliverable physical product are staying elevated. In some cases, they're climbing. What does that tell you? It tells you that the real demand for silver, the demand from people who actually want to own the metal, has not weakened. If anything, it's getting stronger. This is the divergence I keep coming back to. The paper market is screaming sell. The physical market is screaming buy. And eventually, one of these markets has to be right. I'll give you one guess which one I think it is. Let me talk about the psychology of this moment, because understanding the emotional landscape is just as important as understanding the mechanics. Right now, retail investors are scared. They see the headlines. They see the price volatility. They hear the narratives about weak demand and the end of the bull market. And they start questioning their thesis. This is exactly what the market makers want. They want you scared. They want you uncertain, because scared, uncertain investors make bad decisions. They sell at the bottom, they miss the recovery, they hand their money over to the patient capital that was willing to wait for the right moment. I'm not saying this to pump you up. I'm not trying to give you a motivational speech. I'm telling you this because it's the reality of how these markets work. Fear is a tool, uncertainty is a weapon. And if you don't recognize when they're being used against you, you're going to end up on the wrong side of the trade. But here's the thing. Once you understand the mechanics, once you see the forced selling for what it is, the fear loses its power. You stop reacting emotionally and start thinking strategically. That's the difference between retail and institutional thinking. Retail reacts to price, institutions react to structure, and right now the structure is telling me that we're in the middle of a temporary dislocation that is going to resolve on January 15th. Now let me address another question I've been seeing a lot. Why does the Bloomberg Commodity Index matter? Why should retail investors care about what some index does with its weighting? The answer is size. The Bloomberg Commodity Index is one of the largest benchmark indices for commodity investments. When it changes its allocation, billions of dollars have to move. And when billions of dollars move in a short time window, it creates price distortions. Think of it like this. Imagine you're at an auction, and suddenly a rule gets announced that says 10 people in the room have to sell their items in the next 5 minutes, no matter what. What happens to the prices? They collapse. Not because the items lost value, but because the forced selling overwhelms the natural demand. That's what's happening in the silver market right now. The Bloomberg Commodity Index rebalancing is forcing a wave of selling into a compressed time window, and it's creating an opportunity for anyone who understands what's actually happening. But you have to be disciplined, you have to be patient, and you have to be willing to ignore the noise. Let me take you inside the trading desk for a minute, because I want you to see what I'm seeing when I look at these data feeds. When I pull up the open interest data on silver futures, I'm looking for the pattern of liquidation. Are the longs being closed out? Are the shorts being added? Is the total open interest rising or falling? Right now, I'm seeing open interest tick down on days when silver sells off. That tells me positions are being closed, not rolled. It tells me the passive funds are exiting, not repositioning. When I look at the volume profile during the trade at settlement window, I'm seeing heavy selling pressure right before the close. That's the signature of index rebalancing. Those are the passive funds executing their mandated trades. And when I look at the spot premiums on physical silver, I'm seeing resilience. Dealers are not cutting prices. Buyers are still paying up. That tells me the physical market is not participating in this paper sell-off. All of these data points are telling the same story. This is a mechanical event, not a fundamental shift. But the mainstream narrative is completely missing it. The headlines are talking about weak demand, about the end of the silver rally, about fundamental deterioration. And that narrative is going to keep retail investors on the sidelines until the opportunity is gone. That's why I'm making this video. That's why I'm walking you through the mechanics and the data and the signals to watch. Because if you wait for CNBC to tell you the coast is clear, you're going to be buying after the snapback, not before. Now let's talk about what comes after January 15th, because that's the part everyone wants to know. Once the forced selling is complete, once the passive funds have finished their rebalancing and the Bloomberg Commodity Index is sitting at its new weighting, what happens to the price? Historically, when these kinds of forced selling events end, you see a sharp reversal. The market makers who pulled their bids during the liquidation come back in. The physical buyers who were waiting for lower prices step up, and the shorts who thought they were riding a trend get squeezed. I'm not saying silver is going to rocket to $100 on January 16th. I don't know what the exact price action is going to be, but I do know that the structural pressure that's been pushing the price down will be gone. And when that pressure is removed, the natural supply-demand dynamic reasserts itself. If the physical market is as tight as the premium suggests, if industrial demand is as strong as the production data, indicates if monetary debasement is continuing at the pace we've seen over the last few years, then the fundamental case for higher silver prices has not changed. What's changed is that we're getting a temporary discount because of a mechanical rebalancing event. That's the opportunity. But you have to wait for the right moment. You have to let the forced selling complete. And you have to be ready to act when the signal appears. Let me give you some historical context, because I think it helps to see how these patterns have played out before. In 2023, there was a major rebalancing in the energy sector. One of the large commodity indices slashed its weighting in natural gas. And we saw a similar pattern of forced selling over a 5-day window. The price got hammered. Retail investors panicked. The headlines talked about oversupply and weak demand. And then, on the day after the rebalancing deadline, natural gas bottomed and reversed 32% in less than a week. Because the forced selling stopped, the structural pressure was gone, and the natural buyers who had been waiting on the sidelines finally stepped in. I'm not saying silver is going to move 32% in a week. Every market is different. Every rebalancing is different. But the pattern is the same. Forced selling creates temporary dislocations. When the forced selling stops, the dislocation resolves. The question is whether you're patient enough to wait for the resolution, or whether you're going to let the fear and uncertainty push you into a bad decision. Now, I want to address something that I know is going to come up in the comments. People are going to ask, if this is such an obvious opportunity, why isn't everyone jumping on it? The answer is simple. Most retail investors don't have access to the data I'm looking at. They don't have Bloomberg terminals. They don't track open interest and volume profiles and spot premiums. They get their information from headlines and social media, and by the time that information reaches them, it's already outdated. And even among the people who do have access to the data, most of them don't have the discipline to wait. They see the price dropping and they panic, or they see the price climbing and they chase. They don't have a plan, they don't have triggers, they react instead of respond. That's why opportunities like this exist, because the market rewards patience, discipline, and information. If everyone had the same data and the same discipline, there would be no inefficiencies to exploit, but they don't. And there are. Let me talk about risk for a minute, because I don't want anyone thinking this is a sure thing. There are scenarios where this thesis doesn't play out the way I expect. What if the forced selling is larger than 7 billion? What if there are other funds beyond the Bloomberg Commodity Index that are also rebalancing, and we don't know about it yet? What if the physical market is not as tight as the premium suggests? These are real risks, and they're why I'm not going all in on any single trade. I'm watching triggers, I'm waiting for confirmation, I'm sizing my positions based on the strength of the signals I'm seeing. This is not a lottery ticket. This is a calculated bet based on structural mechanics and historical patterns. But it's still a bet, and bets can go wrong. That's why I keep emphasizing the importance of having a plan. Know your triggers, know what you're watching for, know when you'll act and when you'll walk away. If silver breaks through 75 with high volume before the 15th and spot premiums collapse, that tells me something different is happening. That tells me maybe the physical market is not as tight as I thought, or maybe there's additional selling pressure I haven't accounted for. In that scenario, I'm not stubbornly holding on to my thesis. I'm reassessing. I'm looking at the new data and adjusting my plan accordingly. That's the difference between conviction and stubbornness. Conviction is based on data and logic. Stubbornness is based on ego. And ego will destroy you in these markets faster than anything else. Now, let me give you some context on why I'm so focused on physical silver versus paper silver. Over my 12 years in this market, I've seen the paper price of silver get manipulated, distorted, and disconnected. From physical reality, more times than I can count. I've seen futures contracts get dumped during low liquidity hours to trigger stop losses. I've seen ETFs face redemption pressures that have nothing to do with the underlying metal. I've seen all the games. And through all of that, the one constant has been this. Physical metal in your possession cannot be manipulated. It cannot be rehypothecated. It cannot be printed. It cannot be rebalanced out of an index. When you own physical silver, you own the actual asset, not a claim on the asset. And in a world where claims are being bought and sold and rebalanced and leveraged, owning the actual thing matters. That's why my personal strategy is focused on physical accumulation during these temporary dislocations. I'm not trying to trade the paper price. I'm trying to acquire physical metal at a discount created by paper market mechanics. And if the physical market is as tight as I think it is, every ounce I acquire during this rebalancing window is an ounce that's being pulled out of the available supply at a below market price. That's the long game. That's the strategy that has worked for me over 12 years. And it's the strategy I'm continuing to execute now. Let me also address the elephant in the room. Why silver? Why not gold or Bitcoin or real estate or any other asset? I'm not here to tell you silver is the only investment worth making. I'm here to tell you that right now, today, silver is presenting a specific opportunity created by a specific set of circumstances. Gold is not seeing the same forced selling pressure because its weighting in the Bloomberg Commodity Index is relatively stable. Bitcoin is in its own universe, driven by entirely different factors. Real estate is a liquid and slow moving. Silver right now is the asset with the clearest structural dislocation between paper and physical markets, with a defined timeline for when that dislocation should resolve, and with a risk-reward profile that makes sense given the data I'm seeing. That doesn't mean it's the best investment for everyone. It means it is the opportunity I'm focused on right now, based on my analysis and my experience. You have to make your own decisions based on your own situation. But if you're already interested in precious metals, if you're already thinking about silver as part of your portfolio, then understanding this rebalancing dynamic is critical. Now, let me walk you through what I'm going to be doing hour by hour over the next few days. Every morning before the market opens, I'm checking three things: open interest on silver futures, spot premiums on physical silver, and the gold to silver ratio. Those three data points tell me where we are in the forced selling cycle. During the trading day, I'm watching the volume profile. I'm looking for the signature of index rebalancing, which is heavy volume during the trade at settlement window in the afternoon. If I see that pattern continuing, I know the forced selling is still active. After the market closes, I'm reviewing the daily price action and comparing it to my triggers. Did we hit 75? Did we break 80? Did the gold to silver ratio reach an extreme? Based on what I see, I'm either making a move or I'm staying patient. In most days, I'm staying patient because the opportunity is not in catching every tick. The opportunity is in waiting for the right moment and then acting decisively. That's the discipline part. That's the part most people struggle with. They want action. They want to feel like they're doing something. But sometimes the right move is to do nothing and wait. Let me give you one more piece of context that I think is important. The silver market is small. Compared to gold, compared to oil, compared to equity markets, silver is tiny. The entire above-ground supply of investment-grade silver is worth maybe $50 billion. That's less than the market cap of a single large tech company. When $7 billion in forced selling hits a market that small, it creates disproportionate price movements. The impact is magnified because there's not enough natural liquidity to absorb that kind of selling without moving the price. But here's the flip side. When that selling stops, when the forced sellers are gone and the natural buyers step back in, the recovery can be just as disproportionate. The small size of the market works both ways. That's why I'm so focused on the timeline. Once we cross the January 15th deadline, the largest source of selling pressure in this market is gone. And in a market this small, removing that pressure can have dramatic effects. Now, I know some of you are thinking, what if I'm wrong? What if January 15th comes and goes and nothing happens? That's a fair question. And the answer is, I adjust my thesis. If the forced selling completes and the price continues to drift lower, if spot premiums collapse, if open interest keeps declining, then I'm reassessing the fundamental picture. Maybe industrial demand is weaker than I thought. Maybe there's more selling pressure coming from sources I haven't identified. Maybe the physical market is not as tight as the premium data suggested. I don't know what I don't know. And I'm willing to admit when the data tells me I was wrong. But right now, based on everything I'm seeing, the most likely scenario is that we're in the middle of a temporary dislocation caused by forced index rebalancing. And that dislocation is creating an opportunity for patient capital. That's my thesis. That's what I'm betting on. And over the next 5 days, we're going to find out if I'm right. Let me close with this. The difference between retail investors and institutional investors is not intelligence. It's not access to secret information. It's not even capital, although that helps. The difference is structure. Institutions have rules, they have plans, they have triggers and risk management and discipline. Retail investors, for the most part, react. They read headlines and make emotional decisions. They chase performance and panic at bottoms. They don't have a plan, so they're always one news cycle away from changing their mind. If you want to compete in these markets, if you want to take advantage of opportunities like the one we're seeing right now, you have to think like an institution. You have to have a plan. You have to know your triggers. You have to manage your risk. And most importantly, you have to be willing to go against the crowd when the data tells you the crowd is wrong. Right now, the crowd is scared. The headlines are bearish. The narrative is that silver's bull market is over. But the data is telling a different story. The data is saying this is a mechanical event, not a fundamental shift. The data is saying the forced selling has a deadline. The data is saying the physical market is still tight, so I'm making a different bet. I'm betting that the crowd is wrong, that the headlines are missing the real story, and that the opportunity is in waiting for the forced selling to complete and then positioning for the recovery. Is it guaranteed? No, nothing in these markets is guaranteed. But is it the highest probability outcome based on the data I have? Yes. And that's all you can ever ask for. The highest probability outcome based on the best data you can find. So watch January 15th, watch the open interest, watch the spot premiums, watch the gold to silver ratio, and when you see the signals, be ready to act. Because the opportunity is not going to announce itself with a press release. It's not going to wait for you to feel comfortable. It's going to appear for a brief window, and then it's going to be gone. Are you ready?